Hello and welcome to Trading 5 Talents. In today's video, I want to cover diagonal spreads. Now, diagonal spreads, what are they? So we use Twitter as an example. So first of all, a diagonal spread is a spread strategy that involves buying and selling an option of the same type, but you have different expiration dates and you have different strike prices. So the same type, that would be like a put or a call. So what we're going to do with a diagonal spread is we're going to short the front month, which means we are going to be selling that near expiration date. That would be the front month relative to the current date. So here we've got a call, and we're going to be selling a call for this front month. We're just using May 20th in this example, and we're going to use this strike, 48.5. Then we are going to long the back month, which means we are going to be buying a call because, again, the call is going to stay the same for the diagonal spread. So we're going to buy a call, but we're going to use a further out expiration, in this example, June 24th, and we're going to be using a different strike price, in this case, the 47 call. So where the diagonal spread gets its name is based on the location of the strike price and the expiration date. So the strike price is a vertical spread, and then the expiration date would be a horizontal spread. So a vertical and horizontal, that's why it gets a diagonal name. You can see that a vertical spread, I have a video regarding vertical spreads and how those are set up. And I also have a video on horizontal spreads or calendar spreads and how those are set up. So you can either use a call or a put, but as long as they are the same, you can set up a diagonal spread. So either both calls or both puts. And when you enter a diagonal spread, it's entered for a debit. You can invert it, but it's just not as common. So in this case, we're just going to be looking at the debit or the long diagonal spread. So here are some other names that you might hear regarding diagonal spreads. So that's going to be based on the long option. That is the back month, the one that is further out in expiration. If that back month option is a leaps, then it can be called a poor man's covered call if you're using a call, or it can be a poor man's covered put if you're using a put. So what is a leaps option? A leaps is actually an acronym for a long-term equity anticipation securities, and it's just a fancy way of saying it's an option with greater than 1 year expiration date. So remember, we're selling the front month, and then we are buying the back month, or you could say we're shorting the front month, and we are longing the back month. Now, if that back month long option is greater than a 1 year expiration, then that is called a leaps option. So if it's a call, you could call a diagonal spread a poor man's covered call, or if it's a put, you could call this a poor man's covered put. So let's look at a diagonal spread, and now we're going to use XOM as our example, and this is going to be a call spread. So remember this diagram where you've got your price line, lowest on the left, highest on the right. You've got your current stock price with this vertical dotted line, and we're going to be looking at XOM. So here we are shorting the 90 call, and we're going to be using the May 20th expiration date. So you can see the 90 call here is the same as this one here. We've got our expiration of 5/20, and that's right here. And we are on the short side of the price line, so we are going to be selling this call. All right. Now, to set up a diagonal spread, what we need to do next is we need to go long on a further dated call option at a different strike price. So that would be here. So now we've got our 80 call, and we are buying this. So we're on the long side. You can see right here, long. And then 6/24 is our expiration. 6/24 is our expiration. So this would be a diagonal spread. Now, if we combine these and we look at the summary, it doesn't come up as a diagonal spread, at least in Robinhood. It just comes up as a 2-option order where we're selling one and we're buying another one. And you can see the short call is 76 cents in credit. Long call is $7.05 in debit. So obviously we're going to be paying a lot more for the long call because of the time value, and we're going to be receiving less credit for that short call because there's not as much time value. So there's an overall net debit of $6.30. So this would be referred to as a diagonal call spread. A diagonal because we have different expirations and different strikes. Call because we're using calls in this example. And we'll take a look at the profit loss over on OptionStrat in just a second. All right, so let's now look at a put spread using the same ticker symbol, XOM. So our price, our current stock price, and here we have our short put. And so we have the 80 put for 520. We're selling this one, and then we're going to be buying the 90 put, 624. Now, this is just an example. I'm not recommending this at all. I'm just showing you what it would look like on Robinhood and what the trade setup would look like on this diagram. All right, so if we put these together and we look at our summary, we are buying the 90 put for $8.58. This would be our long put here in blue. And then we are selling the 80 put for $1.47. This is our short leg of our trade, and this is $1.47 in credit. So obviously the debit is much larger than the credit, so we're going to be paying $7.11 for this this diagonal spread. And this would be a diagonal put spread because we're using puts to set it up. Okay, so let's take a look at profit and losses for diagonal spreads. Now, once again, because these are spread trades, profits and losses are going to be capped. For a diagonal call spread, here's where you're going to get your max profit. It's going to be achieved if the stock price is less than the strike price at the front month expiration. Okay, so that's when your stock price is lower than your short call. The max loss is the debit paid. Just however much you paid to enter the trade, that's as much as you can lose. For diagonal put spreads, it's going to be the opposite. So your max profit is achieved if the stock price stays above the short strike price. That is your front month expiration. And again, we're going to look at OptionStrat to show you how this would work. And then, of course, the max loss is the debit paid, how much you are paying to enter this trade. So let's look at OptionStrat, and we'll use XOM as the ticker symbol for our example. Okay, here we are on OptionStrat.com. Link is down below. And so I'm just going to go to Build, and we are doing a diagonal, and you can find that right here. We'll start with a diagonal call spread, and you can see the summary down here at the bottom. But I'm going to click on diagonal call spread, and we are going to go to XOM, which is Exxon Mobil. And I'm going to set the strikes as we just used in our example. All right, so we did 80 as our strike price for 624. And we did 90 for our short call, and we did that at 520. All right, so here is what the profit and loss table would look like at expiration. If we zoom out, you can see the whole profit and loss profile. It's got this sort of unique shape where it's sort of curved down here in the loss column or the loss quadrant, and then it just has this sharp rise, and then it sort of tapers off here on the profit side. So let me just zoom back in, and this is what we'll see. So in this example, the net debit was $613 or $6.13 per spread, which is multiplied by hundreds for $613 in total debit. That's as much as you can lose on this trade. Now, the profit at expiration, you can see here, is $456.93. So it can't be calculated exactly because of, again, the different expiration dates. So at this particular time with this particular setup, $456 is the max profit. All right, now if we look at this trade, this is the idea of the diagonal call spread. For example, XOM right now is trading at 84.37 when I'm making this video, 84.37. What we're doing is we're going long on the 80 call. So we're buying this in the money call. And as XOM increases in price, this call is increasing in price. If XOM decreases, this call would decrease in price. Now on this short side, the 90 call, this is acting like a covered call when we use the wheel strategy. So as long as XOM stays below this 90, you're going to be in profit. But if it goes past this 80 down here on the 80 side, that's when you're going to start losing money. So what you would want is you would want XOM to get as close to this 90 call as possible, your 90 short call. So you can see as we increase and we get closer and closer to the $90 price, you can see your profit increases until it peaks right at $90. And that would be your max profit, $456. And it says 89 here, but it says your max profit is 456.93. But that's when you're going to get your max profit, is if it closes right at 90. What's neat about the diagonal spreads is that because this is such a long dated call option, this 80 call right here, you can sort of use it as a stock replacement. That is, instead of buying 100 shares of XOM and then selling a 90 covered call on it, you could just buy this call option, this 80 call option, that replaces your stock. And now you can sell sort of covered calls on that option position. So it's like a synthetic covered call. This is why it's referred to as a poor man's covered call when you use a leaps option, because your leaps option is actually the replacement for your stock, and you're selling calls against that long call position instead of selling calls against 100 shares of that particular stock. And the reason it's called a poor man's covered call is because it costs a lot less than buying 100 shares of XOM. So for example, if we took this 80 call and we made this a leap, so let's go all the way out to June of 2023. So that's over a year. So you can see the cost to enter this particular position is $1,235. Okay, that is cheaper than buying 100 shares of XOM. XOM is at $84.37, so 100 shares would be $8,437. Obviously, $1,235 is cheaper than that, so it would be a poor man's covered call. So what you would do is you would buy this 80 call, for example, June 2023, and then you would sell these short-dated covered calls against your long call position. And so once this expires or you get your profit that you want, then you simply sell another one, keeping this 80 call open. And so you can continually sell all of these short-dated calls against this long call position. So that's the idea of a diagonal spread. You can either close it all out in just one transaction, or you can just roll that short call over and over again until it reaches the expiration of your long call. All right, now let's look at how a put spread would work, a diagonal put spread. So just hover over build, go down to diagonal put spread, and we're going to use XOM once again as our example, and then let's set it up according to our example in the slides. Okay, what we did here is we shorted the 80 put for 520, and then we went long on the 90 put for 624. That would be this right here. Okay, so $722 is our net debit. That's the max we could actually lose, but we can gain up to $392.50 if at the short put expiration was exactly at $80. Now, this again is going to work just like the diagonal call spread, except in the opposite direction. So what you can see is the stock price right here is in this dotted vertical line. And as the stock price decreases, you're going to gain more and more money. So the max you can lose, again, is your $722 if the stock just increases. But if it decreases, you can still see that you're making all of this money potentially. If we were to elongate this long put, and let's say we were going to make this long put go out to June of 2023, you can see once again that this would be very similar to a cash secured put, except instead of needing $8,446 in cash as your collateral to sell this 80 put, you would just buy this 90 put, and that would sort of act as your cash collateral. And so the cost of this entire trade right here is $1,482. Again, it's just a fraction of what a cash secured put would cost if you were to make that trade. So you would buy this 90 put, and then you would sell this short dated 80 put, and you'd receive that credit. Then you could just roll it off to the next month and collect that premium, roll it off to the next month and collect that premium, leaving your long put in play for that duration. Now, again, just like the diagonal call spread, you can close them all out in one transaction if you want to, or you can simply roll that short put to the next expiration to gain even more premium. All right, so that's an overview of the diagonal spread, and here are the advantages that I see with diagonal spreads. First of all, they're great for smaller accounts, just like most spreads are, because it costs much less than doing a full-blown strategy such as a covered call, cash secured put, or simply going long on calls and puts. It's a directional strategy, however, so you have to be very comfortable in or at least confident in knowing which direction the stock is going to move. The other advantage I see with diagonal spreads is that, as we just mentioned with the poor man's covered call or the poor man's covered put, you can roll that short leg over and over to different expirations, collecting premium every single time, as long as the conditions are favorable for you to collect the premium. But you use that long leg of your diagonal spread as a replacement for either 100 shares of stock or the cash collateral if you're mimicking a cash secured put. So that is a great advantage for a diagonal spread. And once again, because it doesn't cost as much money, it's better for smaller accounts. Now, here are the disadvantages that I see with diagonal spreads. First of all, capped profits, like any type of spread trade. Second, there's going to be more commissions because now you're opening up 2 trades and you have to close 2 trades. So there will be more commissions. And also, if the stock doesn't move in the direction that you anticipate it's going to move, you're going to be losing money on that long leg because you're long an option. Theta decay is going to start eating away at the value of that option. So I've been stuck in poor man's covered calls where that long leg simply lost more value than I was able to gain on the premium from the short leg. So that is a disadvantage. It doesn't happen with stocks because theta decay doesn't affect stocks, but it does with options. So that is a disadvantage that I would see with a diagonal spread. So that's it for diagonal spreads. If you have any questions about this trading strategy, then go ahead and leave a comment down below or catch me on Twitter at Trading5Talents. In the meantime, if you want to learn more about options trading and these spread techniques, then go ahead and click on the subscribe button and turn on the notifications so you can know when the next video comes out. In the meantime, trade wisely and take care.